Welcome back to the deep dive. Our mission today is, well, it's to take a really monumental piece of financial news, an announcement that speaks directly to the future of digital assets, and synthesize it into clarity for you. We are unpacking the formation of the joint US-UK Crypto Regulatory Task Force.
Yeah, this is a big one. This is a moment that, potentially shifts the axis of global finance. When you look back at the history of international finance, you're essentially talking about two massive centers of gravity.
Wall Street and the city.
Exactly. Wall Street in New York and the city in London. They're the twin pillars, really, of the Western financial system. And historically, pretty much any major regulatory framework or standard that gets adopted by both of these hubs, it tends to become the baseline for the whole world.
It ripples out.
It absolutely ripples out. Influences jurisdictions across Europe, Asia, everywhere. So this collaboration, it isn't just some, political photo op. It's a really foundational move toward formalizing digital assets within the existing global monetary order.
And that's the core message we've confirmed from our source material. The US and UK governments are officially forming a dedicated joint task force focused exclusively on crypto.
Right.
And the significance is just immense because, we are talking about two nations, often competitors in finance, let's be honest, agreeing to bring some kind of synchronized order to an ecosystem that's, well, it's historically prided itself on being borderless, permissionless, kind of decentralized.
And what's immediately fascinating is their stated mission.
Yeah.
Because it perfectly defines the core regulatory tension, that push and pull that this whole sector faces. They're tasked with developing frameworks that have to actively balance three core objectives.
Objectives that sometimes fiercely compete with each other, right?
Fiercely compete, exactly. This isn't a simple policing action. It's more like a design challenge, a very complex one.
It's that famous crypto trinity of regulatory challenges, always pulling in different directions.
That's a great way to put it. So first, you've got innovation. They have to craft rules that are smart enough, flexible enough not to stifle the very technological progress and, frankly, the competitive edge they're trying to harness.
Because if they regulate too heavily,
the tech just moves. It goes offshore. Simple as that. Second, there's investor protection. That's often the direct mandate, driven by public and political pressure, especially after years of high-profile scams and exchange failures that we've all seen.
Yeah, those headlines grab attention.
They do. And third, financial stability. Making sure that the volatility and the sheer volume of digital assets don't somehow pose systemic risks to the traditional banking system or, broader global macroeconomics. Finding that precise regulatory sweet spot where all three of those objectives are met, that's going to be the task force's absolute hardest job, politically and technically.
And that balancing act, that's precisely why this deep dive matters so much to you listening right now. Because if these two nations, with their huge economic footprints, their, distinct legal systems, if they can actually agree on a unified approach, they're not just setting domestic policy.
No, not at all.
They are essentially creating the template, the definitive global standard, potentially, for how crypto is regulated in the Western Hemisphere, and likely for many allied nations globally, too.
And this clarity, this is paramount for institutional capital. This is the so what. This is the thing that could unlock trillions of dollars sitting on the sidelines. The main reason traditional finance, the massive pension funds, the global asset managers, the big insurance companies, the reason they've remained hesitant to fully dive into crypto isn't really fear of the technology itself.
It's the rules, or lack thereof.
It's fear of regulatory uncertainty.
Exactly. These institutions, they operate under incredibly strict mandates, including fiduciary duties that demand they minimize undefined risk. If they can't definitively say who owns an asset legally, how it's classified for tax, or what the capital requirement might be next year, well, their internal compliance departments basically say, nope, stay away.
Too much ambiguity.
Too much.
So this task force, it has the potential, at least, to eliminate that uncertainty through clear policy. And we should see a direct result, shouldn't we? Accelerating key approvals that have been kind of stuck in bureaucratic mud on both sides of the Atlantic.
Absolutely.
We're talking specifically about clearer custody rules. Institutions desperately need these to hold client digital assets securely and, crucially, compliantly.
Huge sticking point. Custody.
Then, robust oversight and auditing requirements for stablecoins, making them a truly reliable form of digital payment, not just a crypto casino chip.
Yeah, trust in stablecoins is fundamental. And critically, streamlined paths for approving crypto-focused exchange-traded funds, ETFs, in both markets, hopefully, creating those accessible on-ramps for retail and institutional investors alike.
Can we just dig into custody for a second? Because
Yeah.
that's a really granular technical detail that institutions lose sleep over.
Please do.
Okay, so for a bank, holding physical gold or shares of stock, that's straightforward. They've done it for centuries.
Yeah.
But holding digital assets means managing private keys.
Which is a totally different ballgame.
Completely different. It introduces unique risks. You could lose them due to human error. Cyber theft is a massive concern, or even insider malice. So clear custody rules that define, the separation of client keys, the required use of cold storage, offline storage versus hot wallets online, and the necessary capital reserves they need to hold against potential loss. These are absolutely non-negotiable for large institutions.
They need a playbook.
They need a very specific playbook. The task force has to provide a unified technical and legal definition of what compliant digital asset custody actually looks like.
And these specific technical and legal definitions, they're like the gateways, aren't they? The keys to unlocking potentially trillions in institutional capital. When the rules are clear, the big money knows it's safe, or at least safer, to move in.
Exactly. They can satisfy their internal governance, their boards, their regulators, and they can finally, accurately price the risk associated with this new asset class.
Which then moves us directly into the immediate market consequences. How does this clarity, assuming they achieve it, actually translate into, tangible capital movement? Where does the money go?
Right. That is the multi-trillion-dollar question, isn't it? It probably defines the next cycle of growth or lack thereof in this space.
It really does.
Well, the central economic principle here holds pretty firm. More regulatory clarity is directly correlated with increased institutional inflows. Institutions, just by their nature, their mandates, they are risk-averse, or at least they need to manage risk very precisely.
They don't fear rules, they fear ambiguity.
That's perfectly put. They don't fear strong regulation. They fear ambiguity, which they translate directly into unmanageable operational risk, reputational risk, legal risk. And we can actually prove this correlation empirically,
How so?
If you analyze institutional crypto inflows, look at the capital moving into funds like Grayscale back in the day, or the newly approved ETFs, the data reliably shows these huge spikes following key moments of regulatory clarity.
Like the features ETFs approval.
Exactly. Or eventually, the spot ETFs. When clear rules arrive, the legal and compliance barriers just drop.
Now, you mentioned capital requirements earlier, and that sounds a bit dense, maybe, but it's absolutely vital for banks, isn't it? This is where the task force's influence could get very specific, especially with international bodies like the Basel Committee on Banking Supervision.
Oh, absolutely critical. The Basel Committee sets the global standards for bank capital adequacy. Basically, how much reserve cash a bank must hold against the assets on its books. Right now, under the proposed international guidelines, banks holding unbacked crypto assets like Bitcoin would be subject to a truly punitive 12,250% risk weight.
1,250%. That sounds impossible.
It's designed to be prohibitive. It means for every dollar's worth of Bitcoin a bank holds, it has to set aside $1.25 in capital reserves. That effectively makes holding crypto completely uneconomical for most banks. It's a clear regulatory signal saying, stay away, too risky.
So that high capital burden is essentially a hard stop sign from the regulators.
It's a massive stop sign.
Yeah.
Precisely. Now, if the U.S.-UK task force representing these two enormous financial systems can agree on a risk classification for certain digital assets that is deemed safer, maybe classifying them like certain types of securities or commodities, or defining them under some new lower risk bucket, they could potentially compel the Basel Committee to lower that risk weight significantly.
And that changes everything.
A favorable reduction in capital requirements changes the entire calculation overnight. It makes crypto investments economically viable for banks and could incentivize massive participation from the traditional banking giants we haven't really seen jump in yet.
Okay, so clarity directly equals reduced risk perception for institutions, which then translates into lower capital costs, potentially higher profitability. Makes sense. But regulation impacts retail traders quite differently, doesn't it? We have to acknowledge that. A lot of early adopters came to crypto because it was the Wild West.
Absolutely. They were attracted by the high-risk, high-reward opportunities completely outside of traditional oversight.
And that's the necessary trade-off, isn't it, for the average retail user? They will probably see fewer opportunities for those purely speculative, zero oversight tokens, the meme coins that pump and dump, and fewer platforms operating completely outside any compliance rules.
That's the trade-off. Less Wild West, maybe less chance of a 1000x return on some random coin, but in exchange, you get immensely increased long-term security. Retail participants gain protection against outright platform collapses, like we saw with SDX.
Yeah, protection from losing everything overnight.
Exactly. Protection from the kind of widespread scams and frauds that have really plagued the sector for years. And potentially protection from manipulative market practices, too. It shifts the environment from one defined by, buyer beware to one defined by actual enforceable rules.
This brings up a really interesting, almost philosophical point, though, about control and financial sovereignty. If regulation tightens and exchanges become hyper-compliant, KYC to the hilt, will the typical retail trader change their preference? Will they prioritize the convenience, the institutional backing, the protection offered by a heavily regulated exchange?
Sure.
Or will they double down on self-custody, holding their own private keys completely independent of any regulated third party? Going back to the original cypherpunk ethos, maybe.
It's the central tension, isn't it, between security, enforced by cryptography, not your keys, not your coins, and security enforced by legislation and regulation. We'll likely see a split, a bifurcation.
How do you see that playing out?
Well, I think the casual user, the person just dipping their toes in, they'll probably opt for the regulated exchange because it's just easier, feels safer from a custody perspective, password resets and customer support. But the more maximalist user, the privacy-focused individual, they'll increasingly move capital into private wallets, hardware wallets, and maybe explore more decentralized, non-custodial solutions.
That choice itself dramatically influences the next sort of inevitable consequence of the task force's work: compliance costs and the whole issue of regulatory arbitrage. We have to talk about the economic reality here. These new stringent regulations, they aren't free to implement.
Not at all. Implementing strict KYC, know your customer, AML, anti-money laundering, detailed auditing, ongoing reporting standards. It requires significant capital investment. You need the infrastructure, the software, the compliance officers, the lawyers.
It adds up quickly.
Very quickly. And when those costs become mandatory, not optional, they act as an enormous barrier to entry. For small crypto startups, for niche platforms, even for individual dev teams working on a cool new protocol. This financial pressure is often just too much.
Which means, what's the outcome?
Which means we'll likely witness an acceleration of regulatory arbitrage. That's the process where projects or platforms literally shop around the globe for the friendliest jurisdiction, the one where the cost of compliance is lowest, or maybe even non-existent.
So a strict US-UK framework could push businesses away.
If it's perceived as overly restrictive or costly, yes. It will solidify the creation of a really stark split between the heavily regulated crypto markets operating within US and UK legal rules and robust, largely unregulated offshore markets.
So we'd actually see capital flowing out to seek less stringent environments, potentially.
Exactly. And we can actually track this. You can use on-chain data analysis to see it happening. We look for capital flows moving into clearly regulated entities, exchanges, or maybe DeFi protocols that are actively seeking US or UK licenses versus capital moving into known offshore exchanges or pure governance-free DeFi protocols that operate outside easy regulatory reach.
So the data would tell the story.
If the framework becomes suffocating, yes, we should expect to see significant outflows towards hubs that are actively courting this innovation, places that make it easier and cheaper to operate.
Okay. And, as we continue to unpack these complex regulatory documents and trends for you, our listeners, it's probably worth taking just a quick moment here. If you find this level of synthesized analysis useful, if it genuinely helps you navigate this complex, super fast-moving landscape, please do consider engaging with this content.
Yeah, it really does make a difference.
It does. Subscribing to the channel, leaving a comment with your thoughts, hitting that notification bell. It actually really helps support us, boost our visibility in the algorithms, and frankly, it allows us to keep dedicating the resources needed to deliver these clear, deep insights into the biggest stories shaping the crypto world.
We try to do the heavy lifting, sifting through it all so you don't have to.
Exactly. Speaking of heavy lifting, let's get back to the tech. Which parts of the Web3 ecosystem are likely prioritized by this task force? Where are the regulatory crosshairs aiming first, do you think?
Well, the sources we've seen consistently point to two immediate focus areas: stablecoins and decentralized finance. DeFi.
Okay. And why those two specifically? They seem quite different.
They are, and they actually represent sort of opposing regulatory challenges. Stablecoins are likely the first target because of their potential role as essentially digital money and the resulting systemic stability implications that come with that.
They're designed to be the rails, right? For transactions, value storage, pegged to fiat.
Precisely.
Yeah.
So if they achieve true scale, imagine millions of transactions per second happening globally using a particular stablecoin. Then a failure is no longer just some isolated crypto event. It's potentially much bigger.
Right. It could spill over.
It could definitely spill over. If a major stablecoin issuer fails, or if the assets backing the coin are insufficient or illiquid or just poorly managed, think back to the spectacular failure of certain algorithmic stablecoins.
Yeah, Terra Luna.
Exactly. That could rapidly introduce instability into the broader financial market. So the task force absolutely must define stringent rules here, things like mandatory, independent, maybe even real-time auditing requirements for reserves, liquidity mandates for those reserve assets, and clear legal liability for the issuer. They need to ensure that stable actually means stable, rock solid.
Okay, so that's stablecoins regulating the issuer, the reserves. But DeFi is kind of the opposite problem, isn't it? It's often designed specifically to remove the intermediary. There's often no central issuer to hold accountable.
That's precisely why DeFi regulation is maybe the ultimate test of 21st century finance law. The existing regulatory toolkit, which is designed for centralized entities, banks, exchanges, brokerages, things with physical headquarters and CEOs, it just doesn't neatly apply.
Doesn't fit.
Doesn't fit. In DeFi, financial services like lending, trading, insurance, they're managed by code, by open source smart contracts, often running on decentralized networks.
So how on earth do you impose KYC or AML requirements on a piece of autonomous code?
That is the massive open question the task force is wrestling with right now. They'll have to grapple with regulating the periphery, perhaps, maybe regulating the developers who deploy the code, though that's controversial, regulating the front-end websites or apps that users access to interact with the protocol.
Going after the interfaces.
Possibly. Or maybe regulating the holders of governance tokens, arguing they have effective control. Or even attempting to classify certain complex DeFi protocols, high-leverage decentralized exchanges or lending platforms as falling under existing financial definitions, like maybe calling them an unregistered securities offering.
That seems legally complex.
Extremely complex. And we also have to consider the unique risks within DeFi itself, like flash loan attacks or MEV, minor extractable value, which is basically sophisticated front-running on the blockchain. These things can actually centralize control or power despite the decentralized facade. It's a thorny issue.
It really sounds like it. And the need for this cross-border collaboration between the US and UK is just crystal clear then, isn't it? Because the technology itself is inherently global.
Completely global.
So if the US and UK can harmonize their foundational definitions, like what constitutes a security versus a commodity versus a payment token, they essentially lay the groundwork for consistent international crypto standards, at least among allied nations.
And that consistency, that harmonization, is absolutely essential for market efficiency.
Think about it. If France, the US, and the UK all treat the exact same digital asset class fundamentally differently, well, it just fractures the market. It massively increases compliance friction for businesses trying to operate globally. It harms competitiveness.
It becomes a nightmare for businesses.
A compliance nightmare. But a unified US-UK stance, that creates a massive harmonized market that makes it substantially easier for legitimate Web3 innovation to scale across these major economies. It encourages interoperability between different systems, reduces the costs associated with moving assets or doing business globally.
So this isn't just about drawing lines in the sand, putting up fences. The task force also has the potential to actively legitimize key, high-growth areas of the Web3 ecosystem in the West, to provide a clear, regulated path forward for the kinds of applications they actually want to see grow.
That's a really important point. It's not just about restriction. It's potentially about enabling certain things. And there are three segments in particular that I think stand to benefit immensely from this kind of regulatory clarity if it comes.
Okay, what are they?
First, the tokenization of traditional assets. This is the whole concept of representing ownership stakes in real-world assets, things like real estate, private equity, maybe shares in a company, even intellectual property, representing them as tokens on a blockchain.
And why does regulation specifically help tokenization? Seems like a tech problem.
Well, it's both. Tokenization fundamentally requires two things to really take off at scale. First, legal certainty regarding ownership. Is owning the digital token legally equivalent to owning a piece of the underlying asset? That needs to be crystal clear in law.
Right, the legal wrapper.
Exactly. And second, operational clarity regarding issuance and trading. How are KYC requirements built into the token itself or the platform it trades on? If the task force provides clear guidelines on both the legal standing and the operational requirements, then institutions can confidently start issuing tokenized assets.
And that unlocks what?
Potentially trillions in previously illiquid or hard-to-trade assets. Think about fractional ownership of commercial real estate or instantly settling trades in private company shares. It's about merging the efficiency and accessibility of blockchain with the established value of traditional finance.
Okay, that makes sense. What's the second area?
Second, the task force's approach will be absolutely crucial for digital identity solutions. We're talking about integrating strict KYC and AML processes directly into the blockchain environment, using technologies like decentralized identifiers or DIDs or verifiable credentials.
Bringing identity onto the chain in a compliant way.
Precisely. This is the necessary bridge between the often anonymous or pseudonymous world of crypto and the highly regulated world of traditional banking and finance. By standardizing digital identity in a way regulators accept, compliant users could access regulated services seamlessly, maybe across different platforms, while regulated companies can fulfill their legal obligations without relying on clunky, outdated paper processes.
So an efficiency boost, but based on clear identity rules.
Absolutely. Efficiency predicated on clear identity governance rules set by regulators.
And the third area, you mentioned an elephant in the room earlier.
The third is indeed the elephant. Central bank digital currencies, CBDCs. Now, the task force itself might not be directly responsible for issuing a U.S. digital dollar or a U.K. digital pound. That's up to the Fed and the Bank of England. But their framework for regulating private stablecoins, digital payments, custody, and digital identity will inevitably provide the necessary regulatory and technical foundation. It builds the whales, the standards, the plumbing that the central banks would need if they choose to pursue their own digital currency agendas.
So a robust regulatory framework for private digital currency kind of sets the stage for sovereign digital currency.
It absolutely does. It's entirely about building the robust, compliant guardrails for a new digital financial system. It makes that whole digital transition seem much more viable and controlled from a governmental perspective.
That really makes you wonder then, if regulation does become truly global or at least harmonized across major blocks, which kinds of projects will benefit the most in the long run? Will it be the ones built on legacy systems that are somehow adapted for compliance? Or will it be the brand new entrants, the ones that were designed for regulatory integration right from day one?
That's a fascinating question.
It's something for you, the listener, to really consider as this all plays out over the next few years.
It is. And that ambiguity, that uncertainty about winners and losers, leads us directly into the risks and the challenges inherent in this whole ambitious endeavor. Because the goals sound noble, right? Innovation, protection, stability. But the path is absolutely full of potential pitfalls that could negate the benefits entirely if they get it wrong.
So what's the major immediate threat to the industry if this task force miscalculates, gets the balance wrong?
Well, the primary risk, without a doubt, is stifled innovation. If the task force, perhaps driven too hard by that mandate for financial stability or investor protection, leans too heavily towards restriction, they could inadvertently just dampen or even kill the grassroots innovation that the sector really needs to thrive.
How so?
Crypto innovation, especially in DeFi, often relies on permissionless experimentation, people trying weird things, building new protocols quickly. If every new idea, every novel financial application requires extensive, costly pre-approval, lengthy legal vetting, the velocity of development, the sheer pace of innovation that we've seen, it might simply plummet in the US and UK.
And that leads directly back to what you mentioned earlier, regulatory arbitrage. But this time, maybe on a massive scale, not just involving the small startups.
Precisely. If the US-UK regulatory environment is perceived as punitive or too slow or just generally hostile to crypto, then major projects, large established crypto companies, even key developer talent, will actively start moving their operations. Their research, their development, their legal headquarters will shift to more crypto-friendly jurisdictions.
And this isn't just theoretical.
Oh, not at all. This is an active global competition happening right now. Jurisdictions like Singapore, Switzerland, particularly the Crypto Valley, and Zug, the UAE, especially Dubai, they are already positioning themselves very aggressively. They're putting out clear, proactive, and often much more innovation-friendly regulatory frameworks, specifically designed to attract these digital asset companies and the talent.
So the US-UK task force needs to compete.
They absolutely need to design a framework that is attractive to innovators, not just acceptable to regulators. It needs to be seen as enabling, not suffocating, if they want to keep that innovation on shore.
But perhaps the most challenging technical and legal unknown, the real head-scratcher, remains how they will handle pure decentralization. How will this task force approach structures that are designed to have no center? Specifically, pure DeFi protocols and decentralized autonomous organizations, DAOs.
This is the ultimate regulatory Gordian knot. It really is, DAOs. I mean, these are governance structures where decisions are made collectively by token holders who are often scattered all over the globe, sometimes completely anonymous or pseudonymous, and critically, often lacking any central legal entity or geographic headquarters.
So who do you regulate?
Exactly. The framework has to decide, will they attempt to create entirely new legal classifications that somehow embrace these novel structures, maybe define them as a new type of nonprofit or a digital cooperative, something like that, or will they try to restrict them?
And restricting them means what, in practice? How would that even work?
Restriction likely means attempting to impose liabilities somewhere. This could involve defining the core developers who initially wrote the code as legally responsible parties, even years later. Or maybe classifying large holders of the governance tokens as having effective operational control, thereby making them liable for the protocol's regulatory shortcomings, like, say, its failure to implement KYC on its users.
Wow. Trying to impose legal liability on distributed, often pseudonymous groups who just owned tokens or wrote code years ago, that sounds revolutionary and incredibly legally challenging.
It's legally fraught with difficulty. And if they do go down the path of restricting DAOs or pure permissionless DeFi, they risk pushing the most technologically innovative, the most crypto-native aspects of the entire sector completely off-chain or onto blockchains and into jurisdictions where the US and UK regulatory reach is effectively zero.
Driving it underground, essentially.
Or simply offshore, where it can continue to develop outside their view and control.
Okay, so to really understand the complexity of the decisions facing this task force, we need to place their effort within the current global landscape. Look at some existing case studies, right? They aren't working in a complete vacuum. They're presumably observing what others have done, right and wrong.
Absolutely, and the most notable example of a large-scale unified framework is already being rolled out right now across the European Union.
That's the Markets and Crypto Assets framework, right? MiCA.
MiCA, exactly. And MiCA is a massive undertaking because it creates a single unified regulatory structure across all 27 EU member states. Its key feature, really, is the concept of passporting rights. Meaning if a crypto service provider like an exchange or a custodian gets licensed in one EU country, say Germany or France, that license is then valid across the entire bloc. They can operate anywhere in the EU. MiCA covers basically everything: crypto asset issuance, crypto service providers, and it has very strict rules for stablecoins, especially around reserves and redemption rights.
So it's comprehensive.
Very comprehensive. It offers a continent-wide regulatory model that you can be sure the US-UK task force is studying very closely, either perhaps to emulate its unified structure or maybe to deliberately differentiate from some of its specific rules, which some argue are quite strict.
And meanwhile, both the US and the UK are bringing their own distinct and sometimes conflicting pre-existing approaches to the negotiation table for this task force. Let's start with the UK. Their focus seems to be heavily on consumer protection, driven by the Financial Conduct Authority, the FCA.
That's right. The UK delegation is likely coming to the table firmly focused on that investor protection element of the mission trinity we talked about. The FCA has already been quite aggressive in tightening retail access to what it deems high-risk crypto products.
How so?
Well, this includes implementing strict rules on crypto marketing and advertising, demanding very clear risk warnings, making sure firms don't promote complex or high-risk crypto derivatives or other products to everyday consumers who might not fully understand them. The UK approach really views crypto largely through a consumer safeguard lens, limiting exposure to volatility and fraud. And that perspective will definitely shape the UK's negotiating stance, especially around stablecoin rules and exchange regulations.
Okay, so UK consumer focus via the FCA. Conversely, the US delegation is entering these negotiations from a much more, well, combative and legally fraught background, wouldn't you say? Driven primarily by the Securities and Exchange Commission, the SEC.
That is the absolutely crucial context for the U.S. side. The U.S. legal landscape right now is defined by active high-stakes litigation. The ongoing SEC lawsuits against major industry players, Ripple, Coinbase, Binance, among others. These cases are actively defining, in real time through the courts, what the U.S. government believes constitutes an unregistered security versus a commodity.
It all comes down to the Howey test, doesn't it?
Pretty much. The foundational legal precedent being tested again and again is the Howey test. It's this old, four-pronged Supreme Court test from the 1940s, originally about orange groves, believe it or not, that's used to determine if an investment contract exists, which would make something a security under U.S. law.
So the entire U.S. position kind of boils down to this fight. Are most crypto tokens investment contracts, meaning they're securities subject to SEC oversight? Or are they more like decentralized commodities, like gold or oil, perhaps subject to the Commodity Futures Trading Commission, CFTC?
Exactly. And the outcomes of these ongoing lawsuits are literally dictating the U.S. delegation's policy positions as they go into talks with the U.K. They are negotiating this international framework while the fundamental legal classification of the assets themselves is still being actively debated and fought over in U.S. courts. This dynamic difference, the UK focusing more on consumer protection rules, the US focusing intensely on the legal definition of a security, that's likely going to be the largest friction point in the task force negotiations.
Trying to build a house while the foundations are still being argued over in court.
That's a very good analogy.
But it's important to note, not every jurisdiction views regulatory clarity as being synonymous with restriction, right? There are examples of more progressive alternatives that the task force could also learn from.
Absolutely. And that's why the experience of Japan is often brought up and is so important here. Japan took action years ago. They proactively enacted clear, forward-looking regulations, becoming one of the first major economies to formally recognize Bitcoin as legal property and regulate exchanges.
And what was the result?
Well, they demonstrated that regulating the space early and clearly doesn't necessarily kill innovation. In fact, it can provide the necessary legal confidence and the structural foundation for legitimate crypto businesses to actually thrive. Japan's approach serves as a really compelling counter-argument to the pervasive fear that regulation inherently means suffocation. It shows that clear, proactive rules can coexist successfully with technological development and innovation.
Okay, let's try to synthesize this huge amount of information now as we wrap up. This task force. It's clearly not just about writing some dry regulatory language. It feels much bigger. It's about defining a major geopolitical and economic strategy for the future of digital assets.
That's the perfect summation, I think. Let's just quickly revisit the critical impact areas we've discussed for everyone listening. First, institutional capital. It's largely sitting on the sidelines, waiting specifically for this kind of clarity, particularly around rules for custody and those crucial capital requirements like the Basel risk weights.
And the moment that clarity arrives.
If and when it arrives in a workable form, we should expect pretty significant inflows.
Okay, second key takeaway. Second, the high burden of compliance costs. It will inevitably lead to some kind of market segmentation. We'll likely see smaller projects facing intense pressure, maybe forced to go offshore, which will create a clear split between the regulated and the unregulated crypto markets through that process of regulatory arbitrage.
Got it. And third, the immediate technological battlegrounds are pretty clear. Stablecoins because of their monetary stability implications, and DeFi because of its radical lack of traditional oversight and intermediaries. These are going to be the first areas where the rubber really meets the road on any new rules coming out of this task force.
So zooming out, the bigger picture here is that this task force represents a really significant proactive attempt by the world's two arguably largest financial powers to actually manage and steer the growth of digital assets, rather than just reacting defensively, after the next market crisis or blow up.
Exactly. They're trying to shift from being maybe reluctant spectators to being the potential architects of the digital financial future, at least in their jurisdictions.
And we absolutely have to track whether this effort actually achieves broader global consensus, don't we? It's crucial for everyone to watch that global regulatory heat map, so to speak. See if other major economic regions, particularly in Asia, maybe Latin America, follow the US-UK lead.
Because if they do,
then this framework successfully sets the global standard, or at least a major standard. But if they don't, if other regions go a different way, it risks creating a kind of walled garden scenario, potentially isolating the US and UK markets from global innovation happening elsewhere.
A very real risk.
And just as a final metric note for you, the astute investor listening, we will certainly be watching the market reaction closely. Look at how Bitcoin and Ethereum prices react, not just to the initial announcement of the task force, but more importantly, to subsequent news of actual coordinated policy shifts or concrete proposals resulting from this task force, that price movement. It will be a direct, measurable reflection of market optimism or pessimism regarding the future of regulated crypto.
It really is a historical moment playing out, where that fundamental tension between financial security pushed by governments and technological freedom inherent in crypto's design is being formalized into law.
Indeed. So we leave you with this final provocative thought to consider and perhaps explore on your own. When this global, or at least US-UK regulatory structure is finally hammered out and implemented, do you ultimately think the resulting framework will successfully pump institutional adoption to completely unprecedented heights, fueling the next bull run? Or will the inevitable restrictions end up killing the very grassroots, permissionless innovation that made crypto so exciting and disruptive in the first place?
It really is the core tension, isn't it? The fundamental question that this task force, and indeed the whole world, has to resolve.
A question that truly defines the trajectory of the next decade in finance, digital or otherwise.
Couldn't agree more.
Thank you for joining us for the deep dive. We'll see you next time.